Hello and welcome to today's episode. I wanted to show you a company that in my opinion has a great value, mainly because while the fundamentals, the financials, the earnings and revenues are going up, the price of the stock for some reason is going heavily down. And I heard some comments about, oh, this company has competition, etc. But well, that doesn't really explain why the earnings, revenues, and other financial metrics are going steadily up while the price is dropping. And also, the insiders of this company also agree with that, and the company is buying back its shares over the last few years, so it looks very promising. But before we jump into it, please note that the information provided in this episode is for educational and entertainment purposes only and should not be considered financial or investing advice. Remember to always do your own research before making any investment decisions, and all investments involve risk, and past performance does not guarantee future results. Well, in case of PayPal, that's actually quite good because the past performance of the stock price is very bad. It's going down, which makes it a great buy. We can buy a business for a very cheap price, which offers us that good margin of safety. And remember that it's especially risky when we are investing in hot popular stocks, and currently PayPal looks like it's completely flipped, so there's a lot of pessimism and the price of the stock is going down quite rapidly. There was a massive drop from 300 to currently it's at 70 around. So if I'm not mistaken, that's like 70% drop or even more. So this is huge. Right, and what is PayPal? It operates as a technology platform that enables digital payments for merchants and customers worldwide. So basically, it's like payment system. The company provides payment solutions under the PayPal Credit, Braintree, Venmo, Xoom, Zettle, Hyperwallet, Honey, and Payd. So there are many different companies and names inside of this one PayPal company. And the company was founded more than 25 years ago and is from California, United States. In here we can see the chart of PayPal. As you can see, the price was at 306 at maximum, and currently it's trading at around 61. Wow, so it's even lower than what I said previously. Let me calculate real quick what is the percentage decline here. Oh my god, so currently it's 80% down from the top. So if there were some buyers who were optimistic about this company here at the top, currently they got completely crushed and the price dropped 80%. This is completely massive, and that would happen if the company had serious troubles and maybe there was a fear of going bankrupt, or maybe if it was some small cap stock. But in here, for such a big name to see such a huge price drop, wow, that makes me personally very optimistic, because sell here at the top and buy when it's low, right? And currently it's very low. Right, let's look at the financials though. So this company just lost 80% of the value. So if the market is efficient, then we would see 80% drop in its financials. But if you see here the revenues, wait, let me grab a pen. The revenues each year, they're growing. 15% growth, 20% growth, 18% growth, around 10, 6, 5% growth. So all right, it's not growing like the fastest growing company in the world, but it's not correlated at all to what the price is doing. So in my opinion, at least for now, I would say this is some pricing anomaly. This shouldn't look like that. And look, the gross profit margin is at 44%. This is also huge. I think Google, one of the best companies in the world, has gross margin of around 50%. So in here we can see 45-40% gross margin. This is completely bonkers, and it's really great to see that. And earnings per share, look, in here there was a 40% drop. in 2022, but other than that, the earnings per share is growing. But also it's important to note that we cannot really judge earnings per share if we don't look at cash flows, because the company can generate nice money but then invest everything, so the earnings per share will look not so good. So it's important to see if maybe the real earnings are higher or lower depending on the investment activity. If the company is investing a lot, they will show smaller earnings, but in reality they are making a lot of money just investing everything for future growth. And price to earnings ratio, as we can see previously, there was a lot of optimism around this company with the price to earnings ratio at 56, 71, 50, 40. I'm rounding up it a little bit, but you can see that those price to earnings ratio were really high, so there was a huge optimism, and currently it's sitting at 12, so it's around 5 times less than what it used to be in the past. And there is a theory that we can expect the company valuation metrics like price to earnings to go back to the mean, go back to the average. But in this case, if I see that right before it was like 56, 71, 50, that's a little bit too high. So I'm not expecting the price to go up 5 times and hit those valuation metrics, especially if there is a competition in the sector, etc. But still, it's much, much, much lower than what it used to be. So at least if we look at this method of thinking that it should go back to the average, then yeah, we can see some possible movement up because of that. All right, let's look at the financials. There is a lot of cash, so this company, there is no fear of it going completely bankrupt. And also look at this, total debt is 12. I will just look at the first numbers, right? So they have, this is in billions, right? So 12 billions of debt and 10 billions of cash. So there is no way for this company going bankrupt. So why is the stock price crashing 80%? They can pay nearly all of its debt just with cash and cash equivalents. So this is really great. Right, and cash flow, cash from operations, so like the basic things that the company does, so the cash that is going from things like payments, some fees, etc. So we can see that this metric isn't very stable. We have 25% drop, 7% drop, 16% drop, 16% drop again. But in the years that it's going up, we have much higher growth. But that is also because of the things how percentages worked. There is a thing called the base effect, right? So let's say we have something at $100, it drops down to $50, right? So the drop looks, in percentage wise, it looks smaller, right? Minus 50%. If we compare it to the growth back to the $100, we can see, oh wow, first it dropped 50%, then it grew 100%. So some person might think, oh, then it's better than it used to be, but no, it ended up at the same 100%. And this is the base effect in percentages, right? That when you have a smaller number that you add and like multiply by 100%, then well, you end up at the same level. While here, the base number, the first number was $100, 50% drop is back to $50. So here, there's also a little effect around that, but the current note of 6.5, 7.5 here, those numbers are a little bit higher than what they used to be in the previous years. But remember that this company is earning money, so everything is positive. But what I want to see is huge investments. That's what I would love to see. And here we have more data about cash flows from operations. Very important metric for me is this one here, net income compared to depreciation and amortization. So this is the cost of all of the equipment, etc. So they have great margins and also low depreciation and amortization, which is just great. There is some stock-based compensation, for the employees, which often takes away, it like creates more stocks. They do it through options usually, but still this is not very good for shareholders, and it's quite a significant amount. Right, but cash flow from operations is positive for every year, so that's good to see. Right, cash flow for investing, this is what I want to see. And sadly, the last 2 years and the last 12 months, those numbers are positive, which in my opinion isn't that great. I would like them to invest a ton of money, but of course it's not always a good time to invest money. Sometimes you need to realize the profit, so I'm not judging them, but it's not like the perfect thing I would like to see in here. But they are not afraid to invest even large sums. All of those years, the 5.7, 16.5, 5, 3.3, those are big numbers compared to the positive cash flow from investing of just less than 1, 1.5, 3.5. Those are much smaller numbers, so that's really good. And let's see what are the biggest numbers in here. All right, so they made a lot of investment in market and equity securities, so equities, stocks, etc. So it might be good for them to get out. Maybe they already made their profit. There's no more opportunity there in those equities, so they are going out. It's okay if that's what they need to do, then I can understand it. All right, and in recent years we have some net increase in loans. Sold, I don't know, I'm sorry, but I'm not sure what this position means. It's a negative, right? So most probably they're increasing loans. That's what I would say, but what does it mean exactly? Wait, let me pause for a second and think for a moment. All right, so this part, it is about loans. As we saw before, the PayPal has many different companies underneath it, and one of them does some credit, so they like loan money to people. So this is the change. In this case, it's in a bracket. Wait, let me grab the pen. So it's an increase in loans. So they increased the amount of loans that they gave to people. All right. And there's also some other investing activities, but this isn't specified. But it's always good to see some cash flow coming from that. All right. And now cash flow from financing. We can see that they are issuing debt. So they're going more and more in debt, but this is all right as they have high margins, high profitability. They are able to invest that money and get nice returns on that. But look, total debt issues, total debt repaid is very, very similar. So actually what is happening is that they're issuing new debt and paying back old debt at the same rate. And as you could see, they have a lot of cash in the bank, so that's probably why they don't need a lot of new debt. Maybe they don't have enough investment opportunities right now to get more debt. And in here, what I love to see is this position here, repurchase of common stock. So this is what I mean, that the company insiders, the CEO and the board, they all can see that this company is currently undervalued in their opinion, and they are buying back its shares quite aggressively, and see that this number is going up and up and up each year steadily. So this is amazing. I love to see that. Maybe we don't have great investment activity right now, but we have that stock repurchase program that is just amazing, and the quantity of it is also great. If we compare it to cash flow from operations, you can see the cash flow from operations in 2024 is 7.5, while the stock buyback is 6.4. So they are investing heavily into that. So in reality, what does it mean? That at this point here, when the price was higher, it's not only that the price of one stock is higher, it's that there are more stocks overall. So for the same price, you are getting less of the business, while in here you are not only paying less, but you also get a bigger share of the business because there are less shares outstanding because the company bought back its stock. This is just amazing to see. Right, and the valuation at 12, enterprise value to sales is at less than 2, price to book is at 3, but this is okay. This is a little bit high, but for a company from USA this is alright. And they have a lot of earnings generated by this book value, so this is also good. Maybe they don't need a lot of book value investments to get a lot of profit out of that, so this is very good, right? They buy something, and this thing, they don't need to spend a lot of money to get a lot of value out of that, which is also why they probably have the small amortization depreciation, which is also good. All right, let's look at the percentile rank. This will let us say if this company is currently cheap or expensive compared to the metrics in time. So price to earnings ratio of around 11 currently is, when we look at the 10-year history, we are at the bottom 3%. So the price to earnings ratio looks, I don't know, let's say this is the chart of price to earnings ratio. At 97%, the price to earnings ratio is above the current value of 11, but right now it's below, and it has been below only for 3% of the last 10 years. So this is a good time to buy if we look at the comparison of the current price to earnings ratio to all the previous price to earnings ratio. But as I said previously, in the past the price to earnings ratio was even at 70 or 50, so this is just huge, and it was probably too much, and we can see that the price dropped after that. Price to book value ratio is also very low. Price to sales ratio never has been lower, so yeah, it looks very good. But in here we can also see, compared to United States overall and to United State financials, it doesn't look like super amazing. But remember that this company is growing, and this company has huge margins and is buying back its stock and all of the other things that will make this company probably continue to grow a little bit into the future. So this is also great, while some companies that are completely shit and are not growing and have debt problems might have the price to earnings ratio lower and price to book ratio lower, but they are more risky. So still being in the 29 or 30% quartile, that means it's like the only 30% of the companies in the whole United States, right? Whatever that metrics is exactly, probably like S&P 500 or something. Then only 30% of the companies have lower metrics right there. Right, in here we have the same metrics for free cash flows, valuation, etc. But you can see that it is currently also, if there are green, that means it's good. So they're also at the best readings overall. And the buyback yield is also at the maximum. Debt buyback also. So yeah, it looks very nice. In here we have the margins. So the margin, the gross margin is actually lower than it used to be. But margins like EBITDA, EBIT, net income, return on assets, return on total capital, return on equity, all of it looks better than it used to be. And that might be because the cash flow from investing is also boosting those numbers. And if we look at the leverage, so currently we see quite a lot of leverage, but remember that this company also has a lot of cash, so it shouldn't be that problematic. And net debt to EBITDA and net debt to EBITDA minus capex and net debt to EBITDA. Usually I wouldn't look at those metrics because EBITDA is like bullshit earnings. What does it mean? That when you buy a machine, whatever, a computer, right? This computer will work for a certain amount of years, let's say 5 years. And after that, you need to buy a new one, right? So it's a cost buying this computer. But EBITDA excludes it. They say, no, buying this laptop isn't a cost. It doesn't exist, whatever. So they use it to show that the company is better than in reality. But in here, because the amortization and depreciation for PayPal is super low, we can use it because it doesn't change much. Of course, I would prefer not to use it, but I know it doesn't change as much. So those values here are real. They are very low. So there is basically very little debt compared to the earnings that this company has. And if you compare it to the financial sector or the USA, you can see that this company is not risky. So while the price is dropping, while the price is crashing 80%, there is not such a high risk in involving inside of this company. And this is what this slide here is what made me look at this company in the first place. The green and red dots, those are earnings of the company. And here, these are sales. So we can see that the sales of the company are going up while the price is going down. So this is an anomaly. And here some more look at the income statement. So we can see the sales are increasing around 8-7% each year. Gross profit in here it was stable in 2022, 2023, but in 2024 it rose a little bit. The gross margin is also great at around 50%. And at the EBITDA, I don't even want to look at it. Right, net income, we can see that's looking all right. It's, well, in here we have a drop, in here we have an increase, in here we have a drop. So it's not looking super great. But it is expected that in 2025 there will be growth, 2026 also, but a very small one. And 2027 it's also expected to grow a little bit, but you know, those are expectations in the future, so we can never be sure about that. And balance sheet, we can see the book value per share isn't a lot, it's around 20, but with the current price of 60 for a company with such a great profitability, I think it's fair. And yeah, the debt isn't too much. If we compare net debt to EBITDA, well, it increased, the debt increased in 2024, but still it's just half of the EBITDA, so it's very low. There will be no problem with liquidity for this company. And the cash flow from operations, previously it was going down a little bit, but look at that huge increase in 2024. Of course, it's very difficult to say what will happen to this company in the future, especially understanding the fact that there is a big pressure from other companies in the same sector. Right, and yep, the cash flow per share also increased a lot by 60% in the last year. And margins and other ratios. So gross margin, very important to see, it looks good. EBITDA, will not look at it. EBIT is a little bit better, but that doesn't include interest payments, and as you can notice, the real cost. Net income margin of 15%, that's good. Return on equity of 23%, that's very nice. Return on assets of 6%, that's quite low, but we can see that while using the debt, the return on equity, which includes the debt, is much higher, 24%, previously 27, 22, so always above 20%, which is nice. And this company effective tax rate 16, 17, 21 is actually good that they are paying taxes, because that means they're doing everything legal. And the growth rates, well, they are not great. but they are not bad either. For a big company to grow around 8% or 7% each year is quite good, especially with the low valuation currently. And here you have more valuation metrics like price to sales, price to earnings. So currently it is quite low. And here we come to the analyst's opinion. So those are in here the black line is the average opinion of 44 analysts from like banks and brokerage houses. They say that on average that the price of PayPal currently should be around $80, while it is at 61 right now. So it is below that, below what they think it should be. And the target difference is 35%. And if you can see, a lot of them are saying hold, and some buy or even strong buy. And here another chart showing how the revenues grow way quicker and not correlated to the price that just dropped. So this is good. This means there is an anomaly in the stock market. And in here, earnings per share, we can see that they are not so stable, but still there is no correlation between the earnings of the company to the stock price of this company. In here we have some more information. In here, who holds the company. So you can see it's Vanguard, BlackRock, big institutions, big banks. So if there is some problem, the companies will try, I don't know, to screw over the shareholders. Then those guys have tons of lawyers and will protect us. So this is also beneficial for us. And here is a list of ETFs that include PayPal. And look, there are also ETFs that are crypto based, and this is because a part of the PayPal business also is in crypto payments, etc. And dividend yield, current dividend yield is at 1%. This is low, so it's okay. They are buying back its stock, which is much better than paying out dividend, because paying out dividend is doubly taxed, right? So if they earn $100, then they pay 20% in taxes. So after they pay taxes, it's $80. Then they send you money and you pay tax again, another 20%. So it will be $16. So you end up at around $64, so nearly half of the original amount. That's why, if it's possible, I prefer not to have the dividend paid out by the company. Right, and that's everything. Let me sum it up. This company, in my opinion, is an anomaly because the financials are moving in the opposite direction of the stock price. But as always, remember, it's just educational, and remember to always do your due diligence and always do your own analysis, because even though the company, in my opinion, is a little bit underpriced, then the stock market can become even more pessimistic and the price can drop even more. So if you're buying using leverage or etc., even if you buy the right company for a good price with leverage, you can still lose everything. So yeah, be careful. And that's all for today. Thank you very much and have a great day.